Hello everybody, thanks for tuning in on my channel. I'm Jan Lawrence, and today we're going to discuss the stock market and how what outlook it has for the next couple of days, weeks, and what has happened actually in the last week, because stocks have been going crazy again, like we saw back in March, and these prices are falling, not shooting up yet, but I'm sure it's going to happen again. It's very volatile, and that's why everybody should be aware of how much risk you really want to put into the stock market and how much money you want to expose to that risk. Okay, so first of all, a lot of economists have been saying that the market has been overvalued over the last couple of months because tech stocks have been just pushing indexes, and therefore we've seen high prices on all other sectors, even though they haven't performed well. I mostly believe that this overvaluation has come due to the fact that a lot of people were suspecting that the coronavirus is not going to, or the illness, that we're not allowed to say the real name here at YouTube, that the illness would not last that long. And what we've seen in the past, how trends have developed, and what we're seeing right now is scary. Like today, Germany has stated that they're going to have a national lockdown. France is already having one, and many other countries in Europe are going already with that second lockdown. I'm here in Austria at the moment, and they're having a meeting at 2 p.m. right now. So yeah, just started, and very curious what's going to happen. However, speaking about the market and a few factors that we have to consider when investing, and so we know that our investments are going to be steady and not being exposed to high volatility. Therefore, there is that volatility index, and you could also call it the fear barometer, and it works like any other index. You can literally just track the chart, and high values will give you the information that it is quite volatile, whereas low values show you that, okay, people think there should be steady growth. And historically seen, we've only had such high values back in 2008 for the financial crisis and 2001 with the dot-com bubble. Considering that, you might want to take a little bit of a percentage out of the market, just because you really don't know what's going to happen in the next couple of months. Another good indicator of how well valued the market is at the moment is the stock market to GDP ratio. It's also called the Buffett index, and that's because of the fact that Warren Buffett once called it the closest thing to having an actual indicator of how fairly valued the market in total is. It works like this: you take for instance, the whole American market, and divided by the domestic product of the Americans, and the ratio that comes out here will give you a percentage. And if it's below 1%, if it's below 100%, you could say it's fairly valued or undervalued, and if it's above that, you might claim that the stocks are overvalued. But you have to be careful with this. This worked back in the days. Nowadays, we've seen fairly high values, so like 115 to 125% over the last couple of years, and that's just because tech stocks have been valued that highly without having the earnings that high. Also, their price per earnings is way higher than, like, for instance, oil company. But just like, these are small measurements you can take into account when looking for an investment.
Okay, here's a small graph where you can see how historically the P ratio on the S&P and the volatility index have differentiated, and when volatility was high, also the price per earnings ratio was high, and yeah, vice versa. On the second slide, you can just see how the stock market and the GDP play together, and I've just listed how you can see a fair valuation or an overvaluation, and as you see at the moment it's at 203%, which is way too high.
As already indicated with the Buffett index and the volatility index, there are also a few other measurements that you can look at when wanting to know how safe your money is in the stock market at the moment. With that said, we should look at the US corporate debt and how it's distributed at the moment. I've read this in a news article where somebody from BlackRock stated that at the moment the US corporate debt is at about $10 billion, and that would be 47% of the economy. However, 50% of these 10 billion, sorry, 5 billion are issued to triple B companies, and they're at the low end of the bracket, and that's not a very good sign, because with now not having that much business, or maybe having to shut down completely, these businesses who usually rely on their cash flow and don't have that big of money set aside are getting in trouble. So surely the stimulus checks that have been issued to those kind of companies have helped, but in the long run it's just going to be very tough for them to remain afloat. And as we all know, if companies can't pay back their debt and have to file for bankruptcy, yeah, it's not a good sign for the economy. And that's why you should also take into account that there might be some actual damage done on that side. When looking at the chart, unemployment is also a quite interesting thing, because when we're talking about true unemployment, we're looking at how many people are really in a certain country who have no job. And unemployment has been at all-time lows over the last years, and that has shown to be a bad sign, because firms are overhiring, they're spending too much on people's labor force that they don't actually need, and that also can lead to depressions. And when looking at where the true unemployment rate has been low, the following years have been rather bad for the economy and trended near to recessions, or have been like 2008 ended up in a huge recession. Also, US Treasury bonds are trading at an all-time low margin. So the 10-year US Treasury bond, I think it's at 0.77%, and that's really bad, because people decide to put a lot of money into Treasury bonds because they just believe it's the safest place to put their money. They don't want to leave it at the bank. Therefore buy stock bonds issued from the government. And if people are willing to take, when inflation adjusted, -1 to -2% rate on their money, they have really fearful of the markets and all other investments. Also quite interesting is, even though a lot of people have been gaining money from the stock market lately because of the high rise from March 23rd to September 2nd, when the Dow Jones hit the all-time high, there have been 19 weeks of consecutive sell-off in equity funds. So that means people are taking out their money and trying to realize gains, because they assume that something bad is going to happen, as we're seeing right now. Today again, stock markets are falling 3-4%, and yeah, I think it's not going to be over with this day. So that's how the situation is at the moment. People are fearful of the market and do not know where to put their money. If they have some spare money aside, I mean, that's great if you have to worry where to put your money. But all in all, it's just really a tough year for the economy and also for every individual who's jobless or whatever. It is really tough, and that's just a display of how bad things are actually going. So be sure that you have some money set aside, an emergency fund, because we don't know how long this is going to last. And keep your investments diversified and just try to get ahead of what you're doing, spend less, and I wish you all the best. Hope you could take some information out of this video, and best of luck to everybody. Please like and subscribe and turn on your notification bell, and see you next time.